Hey everyone, welcome. Good to see you guys. Hope you had a great day. It was a pretty interesting day, but I'm finally back from traveling. Got in late not super late last night, but last night, and I am a little tired, so we might go a little bit shorter than normal today. Just depends on how much we have to talk about and how much energy I can keep up because I'm a little sleepy or at the moment. Hey James, great to see you. Hey Pete and Tom, great to see you guys. So what? Let's get an update on the market first. Get a feel for wherever everything is landing. Get the feel for the lay of the land, and then I wanted to talk about a little bit more portfolio stuff. AK, missed this all week. Oh, okay. Did we have? Yeah, we didn't have one the last 2 days because one, I was getting ready to travel, and then I was on the plane yesterday. So this is the first one we've had this week, so we got a little bit of catching up to do. So SPY, well, it is so far done exactly what we expected. So we talked about how after this huge day right here, we were mostly going to chop within this range. We did get a little bit directional this week, just at the opening of the week, but the week after this move was flat. It did very volatile, but flat, nice wide range inside here. But where we closed right here is pretty much where we closed right here. And then over here, so far, where we opened right here is pretty much where we closed right here. So minus the gap up from over the weekend, we've really just chopped sideways so far. And we've been chopping sideways above the EMA 8 instead of across the EMA 8 and EMA 20. But in a super high volatile environment, that doesn't really mean too much to us. All I care about right now is that volatility is still elevated. Realized volatility is elevated. Yesterday, it seemed like it was calming down, but today, not so much, especially with this big tail right here. If we just had the open to close range, then that's a little bit more in line with what we've seen. But with this big tail right here, that is basically more than doubles the size of this candle. So it just shows us that realized volatility is still very much inside the market. If realized volatility is in the market, for sure, implied volatility is going to be in the market. So implied volatility elevated being matched by relative or by realized volatility, which means that ever since this day, market makers haven't really had an opportunity to really recover their money. Over here, it's like, okay, IV is elevated, but realized volatility is elevated. That doesn't give that means they make their normal profits. It doesn't mean that they make outsized profits in order to make up for this loss. At some point, except for yesterday. So at some point, it's going to swing around. They're going to keep implied volatility up. Realized volatility is finally going to calm down, and then they'll be able to make up that money. So until then, I'm not really expecting VIX to drop significantly. The other thing that we had this morning was VIX options expired this morning. And so we got the new VIX rolls coming in. And so we get to see where the market is positioned itself in terms of the VIX options. And then we also got a interesting little move today right here where we were at first chopping sideways, quiet morning, then we got some direction to it. And then over here, it's hard to, this bar right here. See, there's a crazy, crazy tail on this bar. We're traded way, 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 way down below the EMA 20, traded back up in the same 5 minutes. And then the market did continue its downward movement. But if we just chop this tail off right here, it would look like a completely normal bar and everything looks just fine and dandy. This, however, is very telling. And even though we did trade down to a similar level or a little bit below that and then recover above the EMA 8, the fact that this happened right here, especially not as like this as well, the fact that it did trade down here and recover back up, but especially this 5 minutes right here, just goes to show that there is a lot of volatility still in this market and it's still very, very news driven. And this was a fear out of the White House that I think they said that they may be raising tariffs again. So there's some fear of that. It traded right back, but then with more normal market action, traded right back down and then retraced back upwards. Just barely, by the way, getting back above the EMA 8. Not that much. It's not that comforting that we closed above the EMA 8, given that we violated the EMA 20 to, we'll just call it 2 major times. This would be part of the same violation. So are we super comfortable that we're going to stay above the EMA 8? The answer is no. We've got a lot of volatility here. I think the market still has a lot to work out. There's a lot of things to be confused about, to be concerned about, to look at going on in the market. And that's what we really saw today right here with that sell-off and recovery. So until we break out of this range, I'm not going to change my +1 neutral position on my positions. Slightly bullish, only because, I mean, I'm at the verge of going neutral actually, but only because we've got that this MA50 has been holding, okay? Only because of that. So if we go below MA50, I'm definitely going neutral, or depending on how it gets violated, maybe slightly bearish. For now, as long as it can stay inside of this area, then we'll be slightly bullish. If we do break out above definitively, not this super high volatility junk, but like this, smoothly go up above it, then I can go +2 bullish again. But for now, it's just slightly bullish. The other thing that I'm starting to monitor and be aware of is margins. So the amount of margin in accounts is historically high. If I remember correctly, it's never been this high before, meaning that when you buy a stock, generally, if you have a margin account, then you're only putting up half the cash. And then the other half of the cash you're borrowing on margin. So, or on options, same thing. You have options, then generally half of it is on margin. And especially if you're doing spreads, it could be a lot more than half of it is done on margin if you're doing spreads. So what's happening right now is the total net amount of margin, basically borrowing, short-term borrowing, has reached over $1 trillion. And that is the highest that I ever remember hearing about it. I don't have the exact data, so I can't say for sure that it's an all-time high, but if it's not an all-time high, it's pretty darn close to it. So that means margin calls can happen very easily. So if anyone gets offsides, this market is super bullish, and if there is some sort of breakdown below the MA50 or lower, a lot of these positions may get margin called. It's a lot easier for them to get margin called if a lot of the cash in the account is already being used up. So if something breaks and we start to go a little bit bearish, it can really quickly snowball and become very, very bearish. Now, I don't really expect that to happen until we break the MA200, but still it's something to be aware of. It's a little bit far down the line, but it's something that is in the back of my mind that I want to keep within my awareness. I know it's not front and center. I don't need to be fearful of it and trade based on that yet. But if we start to see the signs of the market rolling over, then we really want to be aware of that. Another thing that I can look at to just confirm how concerned or how soon I should be concerned about that. So I can go over here to the momentum levels, market performance levels. Okay, and just see how many stocks are trading above their 50 and 200. We can look at 100 as well, but the 50 and 200 are going to be the most important ones. And what we're seeing here is in a lot of sectors, there's just actually not a lot that are above their MA50. If I look at the overall index, actually 49% of stocks, so not even half the stocks are above their MA50. The SPY itself is above it, so that tells me that market cap is coming into play right there. But overall, the number of stocks is below 50%. We've got 63% above their MA200, so that's fine. That's fine for now. If we start seeing 58, 57, 56, 55, we're going to start watching that very carefully. And especially if it breaks 50%, then for sure we'll want to be hyper aware of any of bearish movement inside the markets. So right now, basically this is telling me I don't have to be imminently concerned about that, but it's just at the back of my mind. I want to start thinking about that as we add on or as we put on positions into our portfolios. Okay. The other thing that we should look at, or probably we should have looked at first, was TLT bonds. Okay, bonds are going higher. So that means if bonds are going higher, this price, I guess I should do the 10-year yield. That would probably be easier to see. So you don't have to flip anything. Okay, so the yield is trickling lower. So if that's in line with expectations of rate cuts. So at least those two are matching. What we don't want to see is the government cutting rates, but on the short end, on the Fed funds rate, but the long bond elevates or stays the same. So that wouldn't be good news. So far this is okay, but we'll want to watch that very carefully as well. And then the US dollar DXY. US dollar kind of chopping sideways right here. So it kind of stopped its upward movement, having a little bit of struggle right there, kind of chopping sideways. As long as there's a weak dollar, then the everything bubble can continue. The gold, the silver, the Bitcoins, the stocks, all of that is going up like crazy. That can continue as long as this dollar stays weak. If it gets strong again, then it's not going to really help the situation with the fact that we're near all-time highs in many assets. So if this starts shooting higher, then we can expect pullbacks in a lot of assets. And if it's a sustained trend like this, then it's probably going to, it may run into a bear market. Okay. Then let's take a look at gold. Gold, if you caught on my Telegram channel, my comment that we did 2 days of nice pulling back, actually 3. So one gap down, trade down, gap down, and then traded down to the EMA 20, a little bit through it. Also the quarter to date VWAP. And then it bounced. It's not a confirmation. Tomorrow we may get a confirmation. So I went into an anticipatory trade, anticipating that this is going to go up at the very least to 400. So coming near this high right here. So recovery, bounce back to 400. And I believe that could happen in a month. Okay? And so I put on a butterfly trade. If you want the details of that, just go to my Telegram channel and you'll be able to see the details of the trade that I put on. So if this happens, then we'll see if it breaks out or if it pulls back. Now, earlier I did talk about, hey, we probably want to see consolidation. So it is unlikely, not impossible, but not super likely that we'll just do this. What is more likely, especially after the huge run that gold has had, we're probably going to get at least some sort of consolidation period. And it may chop sideways like this. Okay, that would be a pretty wide range chop. So I don't think it's going to do that. It would actually may look more like what we saw over here, a little bit more of the institutional accumulation type of pattern. Not exactly like this. but you get the idea. You can see that generally the lows are getting higher and the highs are staying in generally about the same region. If we get that, then I'm going to get really bullish on gold. Not immediately, but I'm going to be waiting for and anticipating that breakout above that 400 level. And I would take pretty much right now after all, I did enter a trade, so as a point of entry. And then if I want the lowest risk point of entry, I want to buy it on the breakout, because that means I have a natural area where I can set a nice stop loss right here and get a really good reward to risk ratio, depending on where my target is. Okay, or I could say I only want to trade the 2-to-1. I don't care how high it goes. I'm just going to look for a 2-to-1 trade. You could do that as well. Or you can set the target and you set yourself up for 6-to-1, 10-to-1, or whatever that you might be able to get out of this. But the sooner it breaks out, the more risk I have, because then I would have to do it out here, you see? So if it just broke out from here, then my stop loss gets set way down here. And so for the same target, it's not even a 1-to-1 anymore. Okay, so it's better for me if we see this shallowing pattern, and it also indicates to me that there is a lot of institutional accumulation if that happens before it breaks out. So that's what I'd rather see. But for now, I'm just trading this first leg potentially back up to 400. Silver, not as clean and pretty. It broke through the EMA 20 and quarter to date VWAP yesterday. It failed to get back up above either of those today. In fact, even the high really just stopped at that quarter to date VWAP. So not yet. Okay, for this one, I'm definitely waiting for a confirmation before I would get back into silver. Gold is looking much better than silver today, at this particular moment. It may not tomorrow, or maybe silver will look really good tomorrow, but as of this moment right now, gold is looking a lot better than silver. Hey Marlon, good to see you. Hey Steven, thank you. Bob Blaine, Illinois grain farmer. Venkat, GC closed below the EMA 8 today. Okay. Well, this let me. There we go. Yeah, it did. I'd rather look at the commodity itself, spot price. I'd rather look at spot price rather than futures, right? So just like I'd rather look at SPX or SPY than I would SPY futures. I only look at futures after market hours or outside of normal market hours. So the fact that gold futures are below its EMA 8, not as meaningful to me as GLD, ETF tracking it. And, obviously GLD did close below its EMA 8 as well. Just that looking like it's bouncing off its EMA 20 potentially. So futures, because they're baking in a a future projection, but as well as some people are actually taking physical delivery, and so that skews it a little bit. And so I'd rather look at the actual commodity or ETF that tracks it, just like I would for SPY, SPX. For gold, Newmont Mining has earnings tomorrow. Okay, so Newmont Mining is obviously going to be affected by gold prices, but it has its own thing going on as well. So it's not going to be a perfect proxy for gold. So its earnings will absolutely, it could either decouple it from gold, or it could just keep it correlated to gold. For now, it looks reasonably correlated to gold. and except it actually, you can see it's between its MA50 and EMA20 rather than between its EMA8 and EMA20. So that kind of gives you the same idea, with the same idea wrapped up between gold futures versus gold, or a proxy mining company versus gold itself. There is going to be some differences. So I always monitor the instrument itself, whatever it is I'm interested in, and then you can start evaluating instruments relative to it. So for example, AG, okay, that Silver Corp versus silver, or AEM is another gold miner. It's actually looking pretty similar to NEM. Also has earnings coming up fairly soon. So you can see that there. And then you can see that if you do GDX, okay, looking very similar. That's a gold miner fund, and then GDXJ is the junior miners. They're all looking very similar. So they're highly correlated right now. Sometimes they decouple from each other. So Newmont is trading more like a miner, it is a miner. So that's to be expected. You're very welcome, Tony. Helpful comments on gold. Are you positive on any gold miners, AGI, for example? I haven't specifically looked at gold miners. AGI, below its MA50, so both Newmont and AEM are looking stronger than AGI, but we can take a look at some miners right now. GDX, oops, yeah, that's correct. And then let's grab that list. Okay. There's a lot of them. I didn't realize there are this many. And then are these all, okay. That's probably why. It's because we have non-US traded ones as well. Okay, so Hecla, stronger than any of the miners that we've seen so far, bouncing up above its EMA 20 today. And does it have earnings? It has earnings a little bit further out. Yeah, that's the only one that looks reasonably strong. You could say, I don't like to go into weaker stock like KGC, Kinross Gold, bouncing off of its EMA 8, but not confirmed yet. We need a confirmation bar. And also AU, same thing. Yeah, you say, oh, it's bouncing off an important level, but it is weak relative to many of the other stocks in the sector. And relative to about the same as GDX itself. Okay. So right now, the only one I saw was, what was it? I forgot its ticker symbol, which shows you I'm pretty tired because normally I wouldn't forget something like that. Let's see. All right, was that here? No, not. Wasn't there one that bounced above its EMA 20? Right there, Hecla. Hecla is that's the one we started out with. It must be, yeah, I guess, yeah, it was the very first one, Hecla. So that's the only one that I think is really worth considering right now. Okay, but I would wait for a confirmation and perhaps even a confirmation on gold itself, or if it bounces and crosses, we have a green bar that the close is above the high of today, that would be confirmation. Yeah. Okay. Thanks, Jay Fakata. All right, so let's take a look. So one thing that I wanted to go over in terms of the portfolio stuff is we talked a couple times now where we talked about no more than 10 positions. And Roger, if you caught the VIP room in Roger's and the presentation afterwards with QuantX, Roger made a comment that I didn't even make out here because I didn't think to make it, but is very, very true. And actually, I didn't specifically say it like the way that he said it. What I said was that if you have too many positions, you'll get correlation anyways. And then we did that portfolio. I guess we did say it. I just didn't sum it up in one sentence, I guess, where we took that whole study where we said, hey, we took like 5 or 6 stocks and we said, let's see if we can, let's see what the correlation is, even if we think that they're completely unrelated. And we took an energy stock and a healthcare stock and a tech stock and a industrial stock, and I don't remember what the other ones were. And we went and we looked at the correlations, and sure enough, when we put them all together, there was at least 2 or 3 that were highly correlated with each other. And so if you are trying to outperform the SPY, then you're not, and you start loading up on 10 or 20 or 50 positions, what's going to happen is your correlation is going to merge into that performance of the SPY. And so that's why discretionary funds tend to have trouble beating the SPY because you have too much correlation. So because they're being forced by the rules of their fund or by the investors in their fund to quote, diversify. And I told you guys that you don't want to diversify in your own personal account in a small account. Large accounts might naturally be forced to. If you have over $10 million, if I'm trying to put $100 million to work and I'm limited to 5, then that means that's 20 million per position. And that's not really going to work out. I'm probably never going to be able to get allocated. So the larger the fund is, the more it tends towards correlation towards SPY. And you don't want to do that in your own personal account. You want to beat SPY, especially if you're a small account. Hopefully you want to really beat SPY. You want to, by leaps and bounds, beat the SPY. So one thing that I wanted to point out is because someone asked that question about how would you allocate the morning payout plan, and I answered that there was a reason why we did the study at 1/3 the portfolio. And this would be 30% of your portfolio, but it's pretty close to 1/3 the portfolio. And because it works really well inside a long-short account, a long-short portfolio with less than $10 million. So if I allocate this way, and what I want you to notice is what I said is you want your programs to work really well together. And so if I do a directional program, say like QuantX, and this is neutral, and this is bullish, let's just say, and that gets me to the current +1 score. Then what happens is, if everything is great, if we're in a normal, easy trending environment, low VIX environment, either you could call that 12 or 13 and below, or even the 13 to 20 region. That would be mildly volatile, very low volatility below 13, and 13 to 20 would be kind of normal volatility. If we're doing that, then the neutral trades do just fine. And they have a high chance of winning. And same with the bullish trade. Then everything's operating normally, the way that we expect. It's possible to win both the MPP and the Quantex at the same time. But let's just say you're transitioning. So right now we haven't been taking a lot of MPP trades because it's too volatile. We know that the probability of us losing the trade is a lot higher than it normally is. And so we just don't trade it at all. But let's just say you're in a neutral trade. You're already in MPP when the volatility was low, and then it went up and it expanded and got big. So just like right before October 10th, was it? I think it was the 10th. So right before this action right here, yeah, the 10th, we were in a normal volatility environment, and this day suddenly took us out of it. So what happens to your portfolio at that moment in time? Well, in the neutral, the expanded volatility is like the worst thing that you can happen in your trade, right? But for a directional trade, expanded volatility is actually good for it. Now, if you happen to get the direction wrong, like this was a bullish trade, so then you would lose all four of these. Okay, and that would be a hard day because you lost on all four of your allocations. And so what you might want to do is, and that's why I like to have at least one opposing position on. So even if I'm at a 1 or +1, then I would still want a opposing position on. So I'd rather it look like this. So I've got these two bullish trades right here. And so this is 0, 0, 0, +1, -1, +1, net score of 1, which matches my slightly bullish viewpoint on the portfolio. But if something tanks really hard, like it did on October 10th, like that's a huge bar. So if something like that happens, then this would lose, 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 and this one would win. Oops, lose, and this one would win. But what's really interesting about this win is it becomes a really outsized gain. It's not your normal size. So here, if it's super bad, I lose 100%. Okay? If my expiration happens to be that Friday, I lose 100%. On these MPP trades, even on that day, the worst we just lost 25%. Okay? Because there's natural protections and stops inside of that position. Okay, so if this was a $10,000 account, then what I've lost here is 250, 250, 250, 1,000, and 1,000. So how much did I lose here? I lost 2,750, which is not quite 3 allocations. So here, if my allocation here, if I make 100%, then I guess all these signs are backwards. Okay, if I make 100%, then I make $1,000 here, net profit. But with such a huge red bar, then I'm not going to just make 100%. I'm going to make several 100%. So you'll see in programs like some of the examples that we give during the presentations and stuff, that there are sometimes you get 300, 400, 500%. I wonder, because we haven't had a huge environment like that during the life of live Quantex trades, but let me see over here. Yeah, I have almost no shorts in Quantex because It's just been so bullish in 2024. So I can't give a good example. But just say if this thing can make 300%, then this has made $3,000. And that has completely made up for it. So net, my entire portfolio is actually up $250. We'll just call that flat, okay? So that is why I don't like to just be long one. Or if I want a 2 or a 3, I generally don't want just like 2 bulls or 3 bulls. Okay, or if it's just one bull. I generally don't want that because I'm not actually protected. However, my loss is limited. Okay, so my loss is limited based on whatever my viewpoint, the likelihood of such a thing happening was. Okay? And if this happens right here, then again, I've preserved 70% of my cash, and that's recoverable. That it takes 42, I think it was 42 to 46%. I think it's just 42% to recover from a 30% loss in your portfolio. That's doable with options. So, and that's why we define this as the very bullish scenario, and we almost never go to a 4 or a 5. So just consider that. I'd much rather be bull, bear, or bull, bear, or even 4 bulls and 2 bears. Did I do that right? No, 1, 2, 3, 4 bulls and 2 bears. Okay, that would get me to my +2. Or we could go bull, bear. That's one way of getting to 3. And the best we could do because we also have the limit of 5 bullish positions at a time. Why? Because if you go 6, then you're going to be correlated. Okay, so I have to do this. I can't do. What am I thinking here? 4. Sorry, that was 4. This is 5. This should be 5. Okay, I can't do 6 and then 3 bears, although that technically fits into my 9 slots. I can't do that because I would have violated the number of bulls I'm allowed to have, because that means correlation. Okay, so I just wanted to point that out, that the worst case scenario over here on the neutrals is actually the best case scenario for if you get the direction right on your directional trades. And so that it still keeps the portfolio balanced. Let me see what you guys are saying. Thanks for gold comments. You're very welcome. All of the gold today. Thank you for dropping these down. You're very welcome. You're very welcome. Okay. So I wanted to go over that. And the other thing that happens is, like, you may be forced. So I showed you guys $5,000 account. That was the example that I was using. But what if you only have a $1,000 account? And so naturally, this increases your risk. If your portfolio, if your starting account size is too small, you are going to be forced to take riskier actions than you would take if you had a larger account. And so you're at a natural disadvantage. So yes, beyond up to a certain point, you are disadvantaged versus slightly larger account sizes. And so what I told you guys on I think the last one, when someone asked me, or I made a kind of this side comment where, hey, the average MPP trade is right around $300. So even if you had a $1,000 account, that MPP trade could occupy 3 of the slots, and then you'd be allocated roughly $300 over there. And so you could adopt the same thing right here, where I don't have to limit myself, just say to a QuantX bull right here. I don't have to limit myself to $100. That might be tough. What if I issue a QuantX bull that costs $300? Am I forced to not trade that? Well, the answer is you could do this. Okay. The problem with doing that is, and I would not do it more than 3 slots. Okay. So no more than 300. So don't do this on a single trade and say, hey, he sent out an alert that where it costs $7 per contract. So I allocate $700 and I've occupied 7 slots with my QuantX trade. Well, number one, you violated the 5 longs, the 5 bulls or 5 shorts. So you definitely don't want to do that. And so if I issue a $500 trade, you still don't want to do this, because if a day like this happens, you're going to wipe out half your account, and that's going to be really devastating. Or it's going to be a lot harder for you to make it up, to come back to your original account size, because now you've got to double your $500 instead of making 40% on $700. Okay. So over here, I would still limit my size to 3 slots max. Okay. So you have $1,000, you go here in a single trade, you've got this QuantX occupying 3, maybe you got MPP occupying another 3. Okay. And what did I say though? This is a little bit of a risky prospect. I'd rather be able to put in a bear here as well. And if I put in a bearish trade over here, then all of a sudden I'm back to neutral again, and I don't have any room unless I do a QuantX or a bull that happens to be less than $100. Okay, so remember, these are single trades. We're treating these as single trades. Okay. So, and if I could do this, then I might as well just have done a single slot bull instead of doing all of that and risking so much in my account. So what you could do though is you could do a QuantX. I'm sorry, I don't know why I'm saying QuantX bull. You could do a bull right here, a $200 bull, and maybe you found a $100 bear. Okay, so this is a single position, but it's occupying 2 slots. And then you have a bear that only occupies 1 slot. That would bring it to a +1, but instead of this being 2 trades, it's just 1 trade. And notice that basically what we're saying is, if ideally what a larger account size would have allowed me to do is to put actually 2 separate trades, and those 2 trades should be uncorrelated trades. But if I do it like this as a single trade, then it's as if I put on 2 trades that were 100% correlated. Okay, so just be aware of that. So again, it is riskier to do it this way, but you might not have a choice when your account size is only 1,000. So what I thought about doing is maybe doing a series, and I wouldn't be able to do it live because, you know, whenever a trade happens is I need to trade it. I can't be, oh, let's all jump on a live stream and trade it right now, because I mean, how many of you would be able to pop on to a live stream right at that moment? Because you're probably following another show and you're looking at your other trades and other things. Like, I can't schedule a time to do something like that. I was thinking about doing a series where I trade a $1,000 account and a $5,000 or $3,000 to $5,000 account and trade it up, and just say using the portfolio management, long short portfolio, and a couple of, so I would definitely small count if I'm trying to increase it. I definitely would far prefer to do it using verticals and butterflies, and maybe the occasional rare single long or single short. And the reason why is because they offer that with verticals, I can design high returning trades. Especially with butterflies, I can return really high reward. I can design really high reward risk ratio trades. It makes it way easier to manage the account, way easier to get performance in the account. Plus, on a butterfly, the management is super friendly. Like, it's in the initial days of the butterfly, if it goes against you, it's not hurting you that much. It's really hard to go into a butterfly if you properly structure it and lose 30, 40, 50% in a single day. But it's very common inside of a single option. It's difficult to lose even 10 or 15% with a butterfly in a single day, the day that you put it on. But it's fairly common with a single call or a single put. So that's how I do it. And I think about doing a series like that, but then they would be recorded sessions like, oh, hey, I'm about to put on a trade. Let me turn on the screen recorder and show you the trade that I'm making. And then I would have to post it after the fact. Okay? So if you think that would be something interesting, that's something that you would want to see and want to watch, just let me know. Send me a comment, shoot me an email, and I will consider doing that. I even thought about doing a program, and I don't know how I would structure it because we have to be very careful with the publishing rules and the laws that may be a service where I say, hey, everyone, let's start out with $5,000 and then we'll trade it up to 10,000. And that would be the end of the service. And then if you wanted to do it again, we could go in for a second round and you would buy into the service again. And then we'd take $5,000 and grow it to 10,000 again. Or we can consider 10,000 into 20,000 at that point as well. So if you're interested in that, let me know, and then I'll talk to publisher and lawyers and all of that to see if we can even legally manage that. We can do that. I even do that legally. So let me know if that's interesting to you. If it's not, then I'm not even going to have the conversation or do the research onto how we could get that done legally. But if there's a lot of interest, then I'll get that ball rolling. Let's see. Guessing most of us here are new to trading. What would be a good first year return on our portfolio matching the SPY or better? First year return, I guess it depends on how beginner you are. Because if you're super beginner, I would only recommend that you trade one contract at a time and you're not looking for performance in your first year. You're just looking to learn. But if you're saying like, hey, I'm pretty new to trading and what I want to be able to beat the SPY on my first year, if you're trading options and you have your mindset correct, which is going to be very unlikely as a beginner to have your mindset correct in your first year, match SPY might be okay because you're using leverage on options to match the equity performance of SPY. So if you were just trading equities only and trying to match the SPY, it might be difficult as a beginner. But since you're trading options and leveraging yourself up, it should be a lot easier to match the performance of SPY. And then later on, if you've got your mindset right, you should be able to very easily and consistently beat the SPY because the leverage should help you do that, right? So the SPY returns, just say it returns 10%, and your average equity return during your trading was, 15%. And you've beaten the SPY by 5%, well, the average return on your options, if you'd done the exact same thing, would be way over 15%. So you would really outperform the SPY. So first year, I wouldn't be concerned about making money. I would be concerned about getting the skill and getting my mindset correct. That is the most important thing in trading. So if you can't get those correct, so basically what you're saying is you're asking for performance before you've really learned and grown as a trader. And your focus is on results. And that means when you go and you trade, you're going to be counting your winners and your losers. And you're going to be highly affected by whether you won or you lost. instead of focusing on the procedure. This is very similar to this discussion that we had in Roger's VIP room today. So what defines a good trade is whether or not I stuck to my plan. And I exited when I was supposed to, I entered when I was supposed to, whether was it a win or a loss. If I say like, wonder, do I have any trades still at BMY? MO? Okay, over here. Over here, I have a trade, or had a trade on BMY. And the plan was right here. It expired right there, okay? I had a target of it coming down to here. Obviously, it did not do that, okay? But this was a butterfly. This was a butterfly, and it initially went well for me, and then it just chopped sideways. So I could have said, oh, let me just take my profit right here. But my plan was either we're going to hold it to expiration as long as it's inside this profit cone, which is in between these two green lines. Or I'm going to hold it until we hit the target, which is at $39. Okay. Or if it completely goes against me, then I'm going to exit at a 25% loss. It never did that. So what we can see here is that it stayed inside my profit zone until expiration. And so I just held it to expiration. I closed it on the day of expiration. That was a good trade. I happened to win it. I didn't win nearly as much as I wanted to, as I thought I could. But it was like a 10% winner or 8% winner. It wasn't that much. I could look at that and be like, oh, that was a crappy trade. It didn't make the 150% that I wanted. I only made 10%. Or I could say, oh, hey, it's chopping sideways. It's not really making that much money. Let me just close it early and redeploy my capital somewhere else. But that was never my plan. That was not my plan for the money. I held it to exactly where I was supposed to hold it. And that's what made it a good trade for me. If I had gone over here and lost the trade, it'd be the same thing. In my book, that is a win because I did exactly what I was supposed to. It's sort of like I'm driving my car and there's a red light and I slow down and I stop right at the line where I'm supposed to, and everything's great. 10 seconds later, some guy comes in, rear ends me and shoves my car over the line, and then another car drives by on the intersection and clips the front of my car. Am I a bad driver? Did I do something wrong? The answer is no. Right? I did exactly what I was supposed to. I followed the rules to a dime, and there were exigent circumstances that caused me to go over the line and then a car clipped the front of me, okay, which would be my fault. That would be considered my fault by the insurance company. But the rear ending would not be considered my fault, and so in the whole bigger picture, they would not consider it my fault. But it's an accident. I got into an accident, but I did everything I was supposed to, right? So I don't beat myself up about it and like, oh my God, I got into a car accident and blah, blah, blah. No, I did everything I was supposed to do. And I perfectly to drive safely, and those rules keep me safe the vast majority of the time, but sometimes they don't. The same thing in trading, okay? If I do everything I'm supposed to do, then chances are I'm going to win a trade or I'm going to do well in a trade. But every once in a while, higher percentage rate than when I'm driving, but every once in a while, something's going to happen and I'm going to end up losing that trade, even though I did everything perfectly. So the evaluation is, did I follow my plan? Did I do everything I was supposed to? And not whether I won or lost. If I end up losing too much when I'm doing everything I'm supposed to, that means I have a bad system. My system is a losing system. Okay, and I need to find a winning system. So we need to stop asking for performance out of the gate and asking for performance out of our trades. We just want at the end of the year to be profitable and hopefully to be more profitable than whatever benchmark we're using. If it's SPY or then it's SPY, that's great. If you want to do that out of your first year, then the question is, can you drive your car perfectly the first year? All right, can you make your trades perfectly the first year? The answer is most likely not. And maybe for something with like driving, a lot of people can drive their car perfectly the first year, but there's still plenty of people who cannot drive their car perfectly the first year. They make all sorts of mistakes, or they don't care about the rules. They just ignore them. How many teenage drivers their first year are going the speed limit and turning on their blinkers every single time and looking over their shoulder every single time? They're not. I didn't do that when I was a teenager either, right? We never went perfectly the speed limit. We never, I did all the other stuff, but I never went perfectly the speed limit, right? You're going to, and then usually something happens that smacks you around, and some people will learn to follow the rules, and other people don't learn their lesson and they keep on breaking the rules. And then they keep on getting into accidents or whatever, whatnot, getting speeding tickets, whatever it is. The same thing happens in trading. You're not going to follow the rules perfectly that first year. I promise you, you won't. Just like you didn't when you were driving. I promise you, you sped at least once during the first year of your driving. And maybe you still do. So either that first year, you get smacked around enough that you wake up and you start following the rules, or you're like the lifelong speedster and never use your blinker type of driver who just lifelong takes these outsized risks on the freeway while you're taking these outsized risks in the market. The difference is the market is going to punish you far more often and far more severely than the roads are if you don't follow the rules. So most likely you're going to get smacked around enough to eventually wake up and say, oh my God, I'm going to start following the rules now. So don't expect that. There's a great Bruce Lee quote. I'm going to find it. Let me see if I can find it. Bruce Lee, learn to die. Here we go. The Art of Dying. Okay, I'm not going to play it here, but I suggest that you watch this video. Okay, Bruce Lee, great philosophy right here. Basically, he says, everyone wants the result immediately. You want to know how to win, and you want the result, but you're not willing to learn how to lose. You're not willing to learn how to, what it takes on the way to winning. So that is why you lose. Until you're willing to lose and you're willing to face losing and fully confront losing, you will lose. You will suffer losses, and you'll suffer them over and over and over and over again, and it will hurt. If you learn how to lose, you will still lose, but you probably won't lose as often. And for sure, when you lose, it won't hurt nearly as much. It's just like in judo, right? Or jujitsu. What do they? You learn to take a fall first. You don't learn how to throw someone. You don't learn how to kick or punch someone, or you learn how to fall, or you learn how to take a punch first in martial arts. It's the same thing. Okay, so you need to learn how to lose. You need to learn how to take a loss in trading before you can get really good and actually win consistently. Because otherwise, you're just afraid. Can you imagine a boxer who's afraid to get punched? They're going to get punched over and over again because they're never going to go on offense. They'll always be on defense. They're always going to be ducking and cowering, and they're just going to get hit. It's the same thing in trading. Okay, if you're always afraid of your losses, if you're always afraid of taking a hit, guess what? You shouldn't be in the ring, okay? Because you're going to get hit over and over again. Yeah. Okay. So I guess a little bit of extension on what Roger was saying in today's VIP room. Hopefully that helps. Okay, so some people are saying me that would be, oh, if I did the $1,000, $5,000 portfolio, I think is what you guys are saying. Yes, please. I was a little confused. Your version of Roger Scott, The Pit, would be really great. Oh, learn my lesson from Pepsi. Okay, good, Tim, great. Okay, all right, that is going to be it for today. Hopefully you guys are learning a lot still. And I'll start to take a look at that portfolio stuff legally, and also in the meantime, I can also do a video series. So not just showing you what my trades are, not suggesting trades or anything like that. Okay, so that's it for today. I hope you guys have a wonderful rest of your day or night, and I will see you guys tomorrow. Okay, all right, bye everyone. See ya.